Most people spend their entire lives following the golden rule of personal finance. Max out your 401k, hit your IRA limits, and wait until you're 59 and a half to finally breathe. But what if I told you that by following those rules perfectly, you might accidentally be building a tax prison for your future self? There is one specific type of account that almost nobody talks about, yet it is the only one that truly gives you permission to live life on your own terms before the government says you're allowed to. The Roth IRA is a miracle of the tax code, and the traditional 401k is a foundational pillar for building wealth. But recently, I've been getting a surge of questions from viewers asking a very specific version of the same question. They ask if there is any point in opening a regular, taxable brokerage account if they haven't maxed out their retirement accounts yet, or if they're already in their 60s and can already access their 401ks. Today, we are going to unpack exactly why the brokerage account is actually my favorite account of all time. We're going to look at the math, the tax strategy, and the psychological freedom it provides. By the end of this video, you'll understand why this isn't just another place to park money, but rather the ultimate freedom fund that bridges the gap between where you are and where you want to be. We have been conditioned to believe that money is only for later. In the US, our financial system is built on age-based milestones. You can't touch this bucket until 59 and a half, you must take money out of that bucket at 73, and you have to wait for Social Security until your late 60s. This creates a very dangerous psychological trap where we have paper wealth, but no accessible wealth. Imagine you are 45 years old and a once-in-a-lifetime opportunity comes up to start a business, take a year-long sabbatical with your kids, or even just pivot careers. If all your money is locked behind the 401k wall, you are effectively broke in the present moment despite having a high net worth. This lack of liquidity creates an underlying current of stress because you know that if life happens, if a health issue flares up or a job market shifts, your own money is held hostage by penalty fees and IRS red tape. The biggest mistake I see is the assumption that because a brokerage account is taxable, it is somehow inferior to a 401k or IRA. In reality, the taxable nature of a brokerage account is its greatest strength because of how the U.S. tax code treats long-term capital gains. When you take money out of a traditional 401k, the IRS views every single dollar as ordinary income, just like a paycheck from a job. If you're in a high tax bracket, they might take 22%, 24%, or even 32% right off the top. But with a brokerage account, if you hold an investment for more than a year, you move into the long-term capital gains lane. For many Americans, that tax rate is a flat 15%, and for some, it's actually 0%. Let's look at a real-world example. Imagine a couple in the U.S. today who needs $80,000 a year to live. If they pull that entire $80,000 from a traditional IRA, they are paying ordinary income on the whole amount. But if they have a brokerage account, they might only sell $40,000 worth of stock, and a huge portion of that is their original principal, which isn't taxed at all. They might only be paying taxes on the growth portion at a much lower capital gains rate. By the time the dust settles, the person using the brokerage account often keeps significantly more of their own money than the person relying solely on a traditional retirement account. This leads us to the concept of tax flexibility. Think of your retirement income like a series of valves. If you have only a traditional 401k, you only have one valve. If you need more money, you turn that valve and your tax bill goes up proportionally. But if you have a brokerage account alongside your retirement accounts, you can blend your income. You can take just enough from your 401k to stay within the 12% bracket, and then pull the rest of what you need from your brokerage account. Because brokerage withdrawals don't count as ordinary income, they don't push you into those higher brackets that trigger things like higher Medicare premiums or more taxation on your Social Security benefits. This is where most people get it wrong. They think about taxes year by year, but wealth building is about the total tax bill over a 30-year retirement. A brokerage account acts like a pressure valve. When the market is down or when tax rates inevitably rise in the future, having a bucket of money that isn't subject to RMDs, required minimum distributions, is a massive strategic advantage. The IRS eventually forces you to take money out of your 401k, whether you need it or not. But they never force you to sell your stocks in a brokerage account. You stay in the driver's seat. There's a psychological side to this that we rarely talk about. I've noticed that many retirees are actually terrified to spend their money. They look at their 401k balance and it feels like a sacred number that they spent 40 years building. There's a massive amount of emotional friction involved in watching that balance go down, especially when you know a chunk of it is going straight to the government. This causes people to live a smaller life than they can actually afford. They skip the trip, they keep the old car, and they worry about every grocery bill. A brokerage account changes the emotional math. Because you've already paid taxes on the money you put in, it feels more like a savings account on steroids. There's less friction when you want to spend it. It serves as a behavioral buffer that allows you to actually enjoy the fruits of your labor. If you want to help a grandchild with a down payment or renovate your kitchen, pulling that money from a brokerage account feels like using your spendable cash, whereas pulling it from a 401k feels like breaking the glass on an emergency fund. Money is a tool for life, not just a scoreboard to look at before you die, and the brokerage account is the tool that is easiest to pick up and use. I want you to imagine your financial life as a house. Your 401k and IRA are the foundation and the walls. They provide the structure and the long-term stability. But your brokerage account, that's the doors and the windows. It's the part of the house that allows for movement and fresh air. Without it, you're in a very sturdy, very safe fortress, but you're also trapped inside. If you have $500,000 in a 401k, you have a great future. But if you have $400,000 in a 401k and $100,000 in a brokerage account, you have a great future and a flexible present. You can pay for a wedding, cover a medical deductible, or bridge the gap to early retirement without ever having to ask the IRS for permission. But here's the catch that catches so many people off guard. A brokerage account only works if you understand the tax stack. Long-term capital gains don't live in their own separate world. They sit on top of your other income. If your ordinary income from a pension or Social Security already fills up the lower brackets, your 0% capital gains opportunity might vanish before you even get to use it. This is why the strategy of when and how you fill these accounts matters just as much as how much you put in them. We often talk about return on investment, but we don't talk enough about return on peace of mind. For me, personally, being 39 years old with health issues that flare up occasionally, my brokerage account is my ultimate security blanket. I know that if I had to stop working for 6 months, my 401k wouldn't help me pay my mortgage today without a massive headache and a 10% penalty. My brokerage account is what lets me sleep at night. It's the sleep well at night fund. When you have that liquidity, you make better decisions. You're not operating from a place of scarcity or fear because you know you have walk-away money that is accessible with the click of a button. Now we have to be realistic. A brokerage account isn't a magic wand. Unlike a 401k, you don't get an immediate tax deduction when you contribute. You're using after-tax dollars, which means you have to be disciplined enough to save even when there's not an immediate carrot from the government. You also have to deal with the temptation of seeing that money in your account. Since there are no penalties for withdrawal, it's much easier to raid your brokerage account for a fancy vacation than it is to raid your retirement fund. You have to be your own gatekeeper. Furthermore, you have to be mindful of tax drag. If you hold inefficient investments like high turnover mutual funds or bonds in a brokerage account, you might end up paying taxes every year on dividends and distributions that you didn't even want. This account requires a bit more intentionality in how you choose your investments. So, What is the actual move here? If you are in your peak earning years, I believe the brokerage account should be your third or fourth priority after hitting your 401k match and maxing out your HSA or Roth IRA. You don't need millions in there to start seeing the benefit. Even a balance of 50,000 or 100,000 can be life-changing in terms of the options it provides. If you are already 60 or 65 and you don't have one, don't panic. You don't necessarily need to move money just to move it. But if you are still working and have a surplus, putting those extra dollars into a brokerage account rather than overfunding a traditional 401k can give you the ammunition you need for future Roth conversions. It gives you the cash to pay the taxes on those conversions, so you don't have to shrink your retirement accounts to get them into the tax-free bucket. At the end of the day, building wealth isn't just about the biggest number on a spreadsheet. It's about the greatest number of choices in your life. A brokerage account is the only account that doesn't care how old you are or why you need the money. It is the ultimate expression of financial autonomy. Whether you're 25 and dreaming of early independence or 65 and trying to navigate the complexities of the U.S. tax system, this account provides the bridge. It transforms your money from a distant promise into a present-day power. So, take a look at your tax buckets. If they are all locked behind age restrictions, it might be time to start building your own freedom fund. I'd love to hear your thoughts. Do you prioritize liquidity today, or are you all in on the tax-advantaged accounts? Let me know in the comments, and I'll see you in the next one.